I'm David Doolin. I'm a CPA, and we have an office in Santa Cruz. PP&Co has about 150 employees. San Jose, Santa Cruz. Our sweet spot is closely held businesses, their owners and their families. We've been doing it for like 85 years. Not me, but many before me. We specialize in tech and real estate and manufacturing and service businesses, the typical privately held companies. And I started in the business in many years ago on the assurance audit side. 25 years ago, I realized I'd have much more fun in the tax side, so I've been doing that ever since, and that's what we do. And yeah, I just wanted to go around to start today and just kind of hear your name and then your business affiliation, just so I get a little sense of the business connection to the law change that just came through. And by the way, we're talking today only about some of the business provisions. There were many individual provisions that are sort of way outside the purview of what we're talking about, but I'm happy to sort of throw anything in that you want me to do that later, okay? And we're just talking again, like I said, about the business provisions. So there's some changes in depreciation rules, R&D expense, which is valuable for a lot of the tech startups. For startup owners, there's this provision called the qualified small business stock deduction, which is helpful for closely held business owners that may be operating a different, either a C corporation or just an S corporation or an LLC. The depreciation rules, and then the qualified business income deduction, the business income interest deduction limitation, the pass-through entity tax deduction, which became kind of prevalent like 2 or 3 years ago, which is a royal pain in the butt for guys who do what I do. And then we're going to talk like, okay, starting a business. I mean, the whole point of this conversation today really is like just sort of to like pique your interest when you're thinking about doing something in your business. How do I best take advantage of the tax law? And I have to say that I think today, more than any time in my career, that sort of the labyrinth with which we go through in decision making is more complicated than it ever has been before. So it creates what it creates. Hopefully, is an opportunity for you to talk to your accountant about opportunities that are out there, given the planning and the decisions and the future-looking things that you guys are doing in your businesses. So let's go to the next slide. The overview. I think historically this is by far the most policy direct tax law that I've ever been involved with in my life. And I think that the general idea is spurring business in the United States. That's very clear that international business is not an objective of this bill, or of just in general. There's some things that so the last time that the current president was president, there was another bill that had a lot of business-friendly provisions in it. Those provisions were set to sunset, shockingly, right after the second term that he was supposed to have, but he didn't. So now he's coming back in, and a lot of this bill takes those things that we're about to sunset and extend them either permanently or for some time in the future. So a lot of this bill is really taking some things that we've had around for 8 years and extending them out in the future. There's errors in the previous law, that his last law that was really challenging. That is a big part of this bill. And then spurring domestic energy production. I mean, if I don't know if you read about it, but most of the energy credits that existed in our existing tax law are going to go away at the end of this year. So the idea is to bring production back in the United States. All right, so let's start with the depreciation provision. There's this thing called bonus depreciation, and what that is basically the ability to write off purchases of certain assets when you buy them first year. And by the way, just to back up, most of the things what I'm talking about today, this is federal. California has a different law for a lot of things, and different states have different laws. So I'll try to bring them up. The depreciation rules do not apply to California. They apply just federally. So what this allows you to do, and when I say you go 180, 60, the last tax law had 100% for a long period of time, then it went to 80, and then it went to 60, and it was supposed to go away. What this does is makes it permanent to take 100% bonus depreciation. You can write off the purchase of fixed assets in the very first year for certain assets that are, you know, under 15-year life, which is something defined by the government. But most real estate is not included in that, although there's a new provision for real property used in the production of tangible personal property. And so if you are a manufacturing company and you buy your building, you can actually write off the building in the first year. So that's valuable maybe for somebody in the design architecture world, because if that just gives them more value. The challenge with all this is these big accelerated write-offs create losses often, and losses can sometimes be limited. So again, getting, you know, sort of running that labyrinth on, like, does this really make sense for us to accelerate this, or do I want to do this right at the end of this year? May or may not be appropriate, but that's where it is. There's all this other thing called Section 179, which is very similar to the bonus depreciation, but again, it lets you take capital assets that you purchase that you normally would have to like depreciate over a period of time and write them off in the first year. Favorable for, obviously, for capital intensive industries. Real estate, if you've got a company that's moving into a new property, or if you're a commercial building owner, and you build out a property for one of your tenants, another area that you can write it all off in the first year, and those are big numbers. So that's something you need to pay attention to. Those are the big depreciation. I think the biggest area of change, at least what for the clients that I deal with I mean, well, they're all appropriate, but for the clients that I deal with on a regular basis, it's primarily small startups or any company that does research and development. The last tax act changed it so that you were required to what's called capitalize your R&D, so you couldn't expense it all in the first year, and you had to amortize that cost over 5 years. Okay, well, I mean, so we had situations where clients, especially clients with revenue, that were taking on venture dollars and were investing a lot in R&D, would actually become taxable because they were investing so much in R&D that they would become, that you had to capitalize it and amortize it, you would suddenly become profitable, which is I mean, anyway, that's just bad policy, and it was something that frankly both Congress and the White House wanted to change during the last administration, during two administrations before the last administration, and obviously the current one, and they could never get it done. So that now has been changed, and we can go back and expense our R&D costs, like which is very positive to innovation. And the other thing about it, which is a little interesting, is if your company has less than $31 million of revenue, you can go back to those years that you were required to capitalize it, and you can write them off. Which creates, again, another decision-making process, which is, do I want to do that? Is it better for me to do it this year? Is it better for me to go back to last year? Is it better for me to catch it? You can catch it all up in 2025. So that's something we're spending a lot of time dealing with. Here's the U.S. piece of that. If you develop outside the United States, you're still required to capitalize that, and there's a 15-year amortization of that cost. So, yeah.
So you're saying that the R&D expenses don't need to be
amortized anymore? Not anymore. Domestic R&D expense. Yeah. Yeah. Okay. Thank you. Yeah. So again, this has a strong impact on innovation-heavy sectors. Obviously, tech is very valuable in our ecosphere, and so it's definitely has a strong impact to that. Please.
Does that apply to payroll expenses too?
Yeah. Yeah, so you're talking about the tax savings, the payroll tax savings from R&D. Yeah, that's okay. Another issue that is relevant to small business owners or tech startups is this qualified small business stock exclusion. And for federal purposes, if you meet certain rules and you're an owner of stock, and the company gets sold, you can avoid paying federal tax on the gain from selling that stock. And it used to be that exclusion was limited to $10 million. It's now been increased to $15 million. Excuse me, for stock purchased after July 4th, 2025. So you have to, the key to that is you have to buy the stock after July 4th, 2025 to apply this $15 million exclusion. It's got to be originally issued shares from a company that's a domestic C Corp, a C Corp formed in the United States, that you got for cash or services. Okay, this has been something that's super valuable, obviously, to business owners who are able to sell their companies for a lot of money. So it's been something we do a lot of planning around. The old rule said that you had to hold it for 5 years to get that deduction. Now there's a provision that says after 3 years you can get 50% for 75% and 100%, which is again favorable for those in that situation.
Sorry, David.
Yeah.
Does this apply only to privately traded or held shares or publicly traded shares?
Well, that's a great question. What if it starts as a privately held company, because you have to be a qualified small business, and a qualified small business under the current law, the new law is you have to have less than $75 million in assets when the shares are issued. So public company isn't going to meet that requirement. And there's certain kinds of companies that don't meet the requirement either. But the rules are fairly liberal when it comes to if your business was to sell for stock to a publicly traded company, you can carry over some of those provisions to your shares into the acquiring company. Also,
you sell those shares later,
it can be qualified given certain requirements. And then there are also rules about like giving to trusts and things like that. You can take that $15 million and really actually make it a lot, because if you give those shares to trusts for your kids, that they can benefit by that as well. So it's a
So the limit is per person, like if you give
it's per owner.
per owner.
Yeah, per taxpayer essentially. So yeah, I mean, and all these things, but again, it's got to be a domestic C corporation. So if you founded your company as an LLC and then converted it to a C corporation, you got shares in exchange for that. That creates problems with this law, because they have to be originally issued by this C corporation. So it used to be that the planning thing was start as an LLC, take your losses in the early years personally so you can get a deduction for it, convert to a C corp, grow it, sell it. That formula doesn't really make sense anymore. You don't see that, because if you want to take advantage of this down the road, you can be really limited on that. Yeah, and then so let's just keep going. Now on the non C corp side, so the privately held business owner who isn't growing it as a company that they're going to sell as the corporate stock of, very likely, there were provisions put in place with the last major change in the tax law called the qualified business income deduction. And if you own a closely held business that's either a partnership, it can be a sole proprietor, or it can be an S corp, you can benefit by, but it's got to be a pass-through. I don't know if you're familiar with that concept, but it's not taxed as its own entity. It actually flows through to you on a K1, and then you're taxed on that. If that happens, then you can still benefit from this qualified business income deduction. The original intention of this was to align the individual tax rates on businesses with the corporate tax rates, which were lowered substantially in the last major tax law. And so that's, again, if you're planning, depending upon what kind of business you're planning, if it's going to be one that isn't really relevant for the qualified small business stock going forward, then you want to focus on things like the qualified business income deduction. And then, finally, well, there's two other major changes. There's a limitation on deducting business interest, which is sort of not taxpayer favorable in that case, and that is if you have it's limited to 30% of your adjusted taxable income, which is basically your taxable income plus depreciation and interest. So it happens when I've got clients that are very profitable businesses, and then they have a down year, but they borrow a lot of money to buy trucks or whatever they buy. You can lose your deduction for interest in a year like that if you have a down year, because you run in foul with this 30% adjusted taxable income. Again, another planning thing, and so maybe that's the year not to invest in certain things because you're worried about losing your interest deduction, or maybe it doesn't really matter and you can push it forward to next year, which you can do.
Interest that your business pays, like for instance, I loaned my business money at a pretty high rate.
Yeah. Do you have an entity?
I have an S corp.
Yeah.
Yeah, and I loaned myself because I couldn't get
Yeah.
anything on the open market for less than 15%, so I loaned it to myself at 15%. But is this going to affect it in a down year?
It could. Yeah. Yeah. Definitely. Again, it's one of those things that couldn't roll forward next year. So maybe if you're having a down year, you want it next year anyway. So it's just something to pay attention to. And then, like I said, the bane of my existence for the last 3 years has been the pass-through entity tax, which is the previous tax law limited you and your ability to deduct state taxes on your tax return to $10,000. That was supposed to sunset that was one of the changes that was going to sunset, and we could get a deduction for the full amount of property and state income taxes that we pay. This law expanded it to $40,000, but didn't get rid of it. So the way that small business owners can benefit by that is to pay what's called a pass-through entity tax, which basically allows you to pay your state taxes through your company and get a deduction for it at the company level, and therefore save you from losing that deduction.
Is the deadline still in June to identify that number?
Well, so California's rules are different than a lot of states, but California's rules are you have to pay at least $1,000 or 50% of your last year's pass-through entity tax to qualify in the current year, which, like I said, it's been the bane of my existence because a lot of my clients don't have their returns done by June, so we don't know what half that number is going into June, and so kind of just guessing. So California is talking about loosening that law so that June deadline is not an issue anymore. They may just charge you some interest or something. Now it's like all or nothing. You miss it by $1, you get no deduction for 2025. So hopefully that goes away. But when we thought that the current sunsetting of that what we call the SALT deductions, which is state and local tax deduction, was coming to play, we thought, oh, we don't have to worry about the pass-through entity tax payment anymore, and now we do. So again, super relevant for S corps, partnerships, and businesses that run like that. Not relevant for a C corp. And so, what does that mean? Let's go to the next slide. And basically, Bill and I talk about this a lot when we meet on clients in common. It's like, okay, you've got somebody, they're starting a company. How do we set them up? And if you're going to be likely to be getting outside investors, if you're not in the real estate business, you're not, an owner and operator of rental properties, but you're developing a business. You're going to get outside investors, and your exit is likely to be through the sale of the company's stock. Then you're like probably going to want to be a C corp. Are you starting a company that's a service business, or a business that you're going to operate for a long time as yourself? And then probably you want a different entity. If you want to take advantage of that pass-through entity tax deduction, and you're an LLC, but you're the only owner, or you and your significant or spouse are the only owner, then you won't benefit by that pass-through entity tax deduction. So you need to maybe convert to an S corp, and we've done a lot of that. All these things are again part of that labyrinth you run through in planning. Like, where do you want to go with this? What are you going to do? And all those things, this change in the tax law has sort of massive relevance on all those decisions. So your accountant's your friend these days. Give him a call as we leave the meeting.